Hello, everyone.
Hello? Okay.
Hello.
All right. Hey, everyone. Thanks for the intro there, Dina. One quick piece about myself, actually, before introing these guys. I'm actually on the verge of the biggest merger of my life, getting married in about 48 hours. So thank you. So some of my last hours pre-merger, so I appreciate you guys
He's
being
running
here.
out right after this to head up there, so.
So introing my esteemed friends here. So Yash, right here on my right, leads consumer investing at Telstra Ventures, where he invests in next-gen media, marketplaces, esports, and MarTech. Telstra has invested in companies such as Snap, DocuSign, Box, Team SoloMid, Skills, etc. Previously, he was a director of corporate development and strategy at AdKnowledge, and was an investment banker at Jefferies, where he focused on mergers and acquisitions and IPOs in the digital media space. So needless to say, Yash is pretty qualified for this panel. And then there's Mike Brooks. I'm kidding. So Mike is at WeatherBug, where he's the SVP of revenue. Prior to that, Mike was actually my coworker for the previous 6 years. So as Dina stated in the intro, we've been through a lot of M&A over the years. So
I think we missed like 12.
yeah, there are probably another 12 or so in there.
There was a whole lot going on.
But yeah, definitely a unique perspective on things. So cool. So starting things off, wanted to get started. First question for you, Yash. From an M&A standpoint, how do those conversations really begin? What do you kind of look at really from the get-go?
Yeah, no, it's a good question. And I'll kind of start off by saying, companies are never sold. They are bought. And what I mean by that is, and I'm glad you brought up your marriage, when you acquire a company, it's like getting married. So you need to start to date a year, ideally, or even 2 years in advance.
Check.
Exactly. And so one of the things that we do at Telstra Ventures is, we've got 55 portfolio companies. As soon as we invest in them, we try to get them connected with some of the key business unit leaders at some of these potential acquirers, right? So it could be Oracle, it could be Facebook, it could be Google, it could be whoever it may be in that space. And even if there isn't an explicit commercial deal, we want them to be on their radar, and in particular, talk to the business unit leaders. So what you'll find is there's a lot of kind of sleazy corporate development guys running around, and I know because I used to be one of them. But they basically are just, a lot of times trying to fish for intelligence. And they don't really have kind of decisions around the ultimate acquisition of a company. They're kind of glorified investment bankers that execute kind of these deals. So it's important to really make sure you find the stakeholders, and usually there's a business unit leader that's kind of pounding the table behind the scenes to really push for an acquisition. So once you do that, then you kind of move into hiring the investment bankers, the lawyers, et cetera. A lot of that stuff is grunt work and commoditized. I think one thing you want to do is really make sure that you've got that relationship because ultimately this will be your new boss, and so you need to have both a commercial and personal relationship.
What percentage of those had that relationship beforehand of some of the acquisitions or some of the investments you guys made? I know that's a big piece of it, but is that 50%? We'll have that 70%.
Yeah, I'll kind of answer that by saying the best outcomes for us as investors and for our entrepreneurs have always been a very strong commercial relationship, right? So when Oracle acquired Moat, that didn't occur, randomly. There was a lot of crossover between their customer bases, and so it just made sense. Their customers were asking for them to integrate better with Oracle, et cetera. Same with Blue Kai, a bunch of these other acquisitions. So I couldn't put it, 50%, but the other, kind of M&As that sort of, or M&Ms, I'll call them, Reggie, that have occurred have really been distress sales, right? So it wasn't an ideal outcome for anyone.
Okay, interesting.
Cool. So from my standpoint, my experience with M&A, obviously, been through a lot, definitely pretty crazy, but from my standpoint, usually really exciting, right? Access to new products. From my side, when Verizon acquired us, we started to have the ability to sell app pre-installs, for example. When we acquired Yahoo last year, we got access to their massive first-party deterministic identity graph, right? So merging all these pieces together really gives us a lot more access, a lot more products to take to market. However, that obviously comes with a lot of challenges, right? So I think Yash was saying earlier, I think the number is roughly 50% of all M&A fails, right? So it's definitely not an easy process. So Mike, from your standpoint, kind of more so at the individual level, when you're being acquired or acquiring someone, what's kind of your advice there?
Yeah, so I'll talk about it more so from a perspective of being even just an individual contributor at a company that is going through a merger. So not if you're a CEO and you're talking about the kind of payouts and things like that, what it's like to be on the ground, like boots on the ground during that kind of process. So there's really two big things that I look for when that happens, because kind of avoid. Alex and I have been very lucky. We've had fantastic managers over the course of our time when we were together at Oath. And got a couple really good nuggets that are really on the interpersonal side of how to behave and how to kind of what goes down during that time. So the first thing I want to talk about is this idea of swirl. So when you have a merger or an acquisition at a certain level, you have this propensity for uncertainty to happen. So you look up and you think your manager is making decisions that you don't understand or you're not involved in. They, in turn, think that their manager is making decisions. There's a lot of uncertainty. And this is by far a negative thing, right? Decisions are likely not being made, but people will often put too much brain space into this idea of the swirl. So it's a very pivotal time for you when an acquisition happens, because a lot of people give up. A lot of people will look around and say, okay, people might be mailing it in, or this is the time where I might get laid off, and kind of why would I contribute? But that's incredibly counterintuitive. So when you start seeing this water cooler talk of swirl starting to happen, do your best to maintain as much distance away from that, because that could take up so much of your brain space and really put you in a bad position. Also, while everybody is mailing it in, that's a massive opportunity to hustle, because no one else is. So, Alex is a very esteemed member of Oath and really high in the ranks now. He did a really good job during all of these acquisitions of continuing to hustle and produce during this time of swirl. So that's generally when an acquisition is announced. Through maybe about 6 to 9 months afterwards, a lot of people give up, but ironically, that is where leadership is looking for you the most to see, to evaluate how you are as an employee. So in those tough times, make sure you turn it on when other people are turning it off, and you could be hosting panels at the Adjust Summit as well. So a really good direction to go. One other thing I want to talk about, it's kind of a tough learning that I had, is layoffs. And this is where we get kind of real about this. And layoffs happen kind of every time, whether it's on the administrative side or it's on sales or what have you. It's a really tough part of what we do. And I want to share a story about kind of a way that I did it wrong. So when I was first at AOL in 2012, I was with the team for about 9 months. Into that, about month 8, I was picked off to be the first hire on the mobile team. And about 2 weeks later, the rest of my team was laid off. And this was kind of merger related, kind of not. But I didn't know what to do. I was 24. This was my first real job, and I didn't do anything. And 2 weeks later, I got a call from my boss who was laid off, and he said, "You never called." And I said, I didn't know what to say. Like, I'm a kid. I don't know how to respond to this. I don't know what to do in these kind of situations. And he's like, look, his dad was an OG AOLer too, been through the ups and downs. When those things happen, always reach out to those people if you want to maintain a relationship with them, for 2 reasons. 1, people remember who reach out, but 2, people remember who don't reach out. So I know some very interesting stories where I have been given meetings in my new life because when other friends of mine were laid off, I reached out, offered to help. And I also know of situations where other people are boxed out of new companies because they resent when their old teammates did not reach out. So that was a really tough lesson that I had to learn when I was early on at AOL, but some really good interpersonal advice that I was given about those situations. Always reach out. Say, I would love to help if I can. You probably can't. but throw it out there, and then 2 years later, when you're trying to work with them together, that's the last LinkedIn message that they see. That's a very positive thing. So, again, the darker side of it, and it happens, but some really good advice that I got for the process.
Just real quick on your first point, to give people a perspective for a reason why you should continue to work really hard is while this sort of diligence is happening around this M&A process, the CEO is actually talking with the potential acquirer around cost and revenue synergies, right? So they're building a model post-acquisition for areas that can either drive up, earnings per share for the acquirer or drive up or reduce costs. And so they're doing diligence on the most productive people around who they should keep and who they should let go. And this happens all the time, but it is a key part of diligence. And they'll interview, kind of all the business unit heads, do a lot of, tech product, market size diligence. But that is a big function of who they decide to keep and kind of let go.
Awesome. Great advice. So, Yash, from a buyer or a seller standpoint, any additional advice kind of to share there? Mike, more so at the individual level, you kind of looking at things more at the company level.
Yeah, sure. So I guess I'll start from a seller perspective, but I think one of the biggest pitfalls I've sort of seen is I think entrepreneurs trying to raise, massive amounts of money just for the sake of it. So to get a big TechCrunch or Recode article, raise 30 million plus, and you really need to think about two things. One is, can you map the use of proceeds of this revenue, or sorry, this cash injection you're going to get to efficiently kind of deploy to increase revenue or enter into a new market? And then two, a lot of entrepreneurs don't realize that they're getting diluted with each one of these raises. So it's better to own 80% of a company that sells at 50 million versus owning 15% of a company that sells at 200 million. Which is much riskier, much harder. There's a smaller buyer universe.
When you're raising money, though, some of the adages I've heard is raise twice as much as you think you need. And then when it comes to attributing how you want to spend that money, how does that go into the equation where you want to raise more than you think you need, but the more money you raise, the more you could fall victim to some of those challenges?
Yeah, there's nothing wrong with raising a lot of money. I just think you need to save some of it for a rainy day, right? So we're seeing like the stock markets, going through a lot of volatility right now. And one thing we've done is advise all our companies to raise on favorable terms when you can and just park it away. So it's good to do that, but I think just make sure you don't kind of inefficiently kind of spend it. And then the other thing is money isn't free, right? So there's this dirty little secret in venture capital called liquidation preferences. And what that means effectively is, if you raise money, let's say you raise 50 million from one investor, they get 1x return on their investment, meaning they get all 50 million guaranteed, regardless of the outcome. So if you sell for 50 million, you may think, that's a great outcome. None of that money goes to the employees, the founders, any of the early investors. It just goes to that one investor. So, I think that happened with FanDuel or DraftKings recently, one of those guys. But that's like a real thing. I mean, SoftBank Vision Fund, they're putting in lots of money right now, but people don't realize they have a lot of kind of leverage in terms of who gets the money back in a sale. So,
yeah. So for those of us who have stock in our equity in our company or options, where are we in that hierarchy?
You are at the very bottom.
Oh boy.
So no, literally, you will lose all of it. And this was a big problem with, I think it was FanDuel. Now the employees and founders are actually suing the investors and a whole bunch of other people. But people don't realize, your stock options are worthless. And so that's why I always kind of advise entrepreneurs to really think about their employees and the other common stock kind of shareholders before raising too much money. Because you need to make sure that you can sell for a 200, 300, whatever plus million, and you've got a reasonable chance of doing that.
So everybody you put in gets their money back, and then the rest is divided amongst.
Exactly, the rest is divided. It's just the scraps, right? And so a lot of times in a distress sale, nobody gets anything, and so that's why I think people don't kind of realize that employee stock options are good, but you need to make sure your management team is not raising too much money on ridiculous terms.
Good to know. Shit.
I didn't want to scare everyone. It's just something to think about.
Drinks are at 5 o'clock.
This panel's over. Awesome. So I think we're kind of right on the edge of leaving time for Q&A. do we want to take any questions from the audience? If not, we could keep talking.
If not, I want to hear Yash talk about the Warriors and the investing in sports.
Yeah, exactly. No, I'm just kidding. Let's keep. Yeah.
So I have a question. Stand up. I think I can speak. Yeah, there we go. So my question is, how do you decide when to do a sale? Like, is it the market has kind of stopped growing, the company stopped growing? Like, at what point is there the decision to say, hey, we need to sell the company?
I guess I can start off.
That's
but
a you one.
Yeah. There's two kind of sales, right? There's one that's a distress sale where you're trying to sell because your investors need liquidity, you need liquidity, you've been around for 10 plus years and growth has kind of plateaued and you're kind of stuck in this twilight zone where you're not really gonna exit. And then you usually hire an investment banker. And then the other kind of sale is, hey, I'm getting a lot of inbound interest, right? So when Instagram sold to Facebook, everyone, Google put an offer. There's a lot of inbound interest, and you kind of need to think about how do you optimize your valuation, when you sell to these guys. And a lot of that goes back to the dating piece I mentioned earlier, years below. So the best outcomes are not done by investment bankers or corporate development teams. They're done when Mark Zuckerberg kind of meets you for dinner and you have just a personal conversation, and he decides to spend $19 billion on WhatsApp.
And it's interesting, I'd add there, didn't even make this connection before, but back before the Verizon acquisition of AOL about 3.5 years ago, Verizon was and still is one of our biggest advertising partners. So that kind of speaks to kind of having that familiarity with that company years in advance.
Yeah, exactly.
Yeah, so those of you in partnerships, you got a big job ahead of you. So that's where this all comes from.
Yeah. Yeah, so anybody in partnerships and trying to really form strategic relationships with the big guys, that's really important further down the line. So yeah.
And one follow-up question there. Have you ever found yourself in a bidding war like that, where you have 20 people at the table, there's one sale going on? How do you participate in that without overshowing your hand?
Yeah, look, acquirers are really cheap, right? So they're trying to lowball you all the time, but there will be occasions where people are trying to, make different offers. And then it's a question of, typically with a lot of M&A, there's an earn-out part of it, right? So, maybe half the deal is paid up front, and then the other half is paid, 2-3 years down after the acquisition based on certain milestones you hit, usually financial. And so what we used to do is try to dress up the final acquisition price by paying as little upfront, but saying, hey, you can make 4x as much if you hit usually unrealistic milestones. And then as a seller, as a CEO, you need to fight back and say, hey, no, I want more upfront and I want more realistic kind of expectations.
What is a fair ask there of upfront versus if I were a CEO with a good company?
Yeah.
What should I expect from a good outcome to get upfront?
So maybe 3/4 of the cash price is upfront, and then maybe a year earnout. The reality is they're going to be pushing for 2-3 year earnouts because they want to keep you incentivized to kind of run the business post-acquisition. And we've seen a lot of issues where if you don't have the founders and the DNA of the company still involved, it becomes just a worthless kind of asset that eventually dies. So they're going to be pushing for 3 years. If you're a founder, usually you can settle at about a 1 year kind of earnout, and usually on some realistic kind of revenue or kind of profitability milestones. Yeah.
Anyone else from the crowd?
The sharp-dressed man up front.
Yes, thank you, Mike. What about, this is for Yash, what about if you're maybe not interested in buying the company, but you want to drive the price up for someone who like a competitor who's driving it? Do you see a lot of that?
Yeah, there is a
We're
lot
not
of
buying
that, right?
anything.
People will put in fake offers where they don't intend to actually buy it, and it even happens on a bigger scale with Time Warner and AT&T. There were a few other people. People will put in offers and then kind of just know that they won't get accepted, and that happens all the time. Not as often as you might think, but it's an important consideration when you're putting in an offer. That's why it's important to really kind of know the acquirer, know the entrepreneur, and really have that trust because even if somebody puts in a higher offer, they may just be doing that to kind of drive that up. So
those aren't firm by any means. They could say it and then they're like, okay,
well, yeah,
we choose that.
All these offers are non-binding, right? So when you sign a non-binding term sheet, It's just, hey, I'm interested. I've got to do diligence, and once I do my diligence, I'll sign the final legal docs. So I wouldn't, get too excited about, a term sheet, because usually they're all non-binding. You just got to go through the hard diligence afterwards, and then you'll know who the real serious buyers are.
Good question, Jay.
Yeah.
Cool. We are right at time if we want to keep.
Can we talk about the Warriors at all, or?
Yeah.
Not
So
after
what's the
last
win prediction total for this year?
About 60, 65 maybe. Depends when DeMarcus Cousins comes back, but that big man situation needs to be sorted out. So I'll leave it at that.
Awesome. Thanks, guys.
Thank
I'm gonna
you.
Go get married.
Thanks, everybody.